Welcome back to Talk Tickers. This is the deep dive for the serious investor, the alpha without the fluff. We cut through the noise, we get right to the numbers that matter.
And today we are definitely sharpening our pencils on a sector a lot of people have basically left for dead.
Regional banking.
Exactly. Specifically, a New York player that just made a very, very loud statement. We're talking DCM, Dime Community Bank shares.
And if you were watching the tape on January 21st, you could not miss that statement. It was a huge outlier. The stock jumped. What was it?
8.63% to close at $32.72. But look, the price move is one thing. What really caught my eye was the volume.
Right.
We saw 1.13 million shares trade hands.
Which for them is just massive.
It's huge. I mean, on a normal day, they're trading maybe 200,000 shares.
Yeah.
So when you see over a million, that's not just retail clicking buy.
No, that's the big money. That's institutional repositioning. It's
the smart money moving back in. This felt like a proof point quarter. The market is saying, okay, this is a bank that's winning on execution, not just, waiting for the macro environment to save them.
It really did. So let's unpack the headline numbers before we get into the mechanics of it. Revenue came in at a record $124 million.
But for investors, revenue is vanity.
Profit is sanity.
Yeah.
And the number that really jumps off the page for me is that core EPS. They hit $0.79 share.
Which is an 88% increase year over year.
88%. Let me just say that out loud. In banking, you fight for 5, maybe 8% growth. That is not a typo. How do you even do that?
It's all about operating leverage. It is the holy grail for bank investors right now.
Right.
Essentially, DCOM grew their revenue, but they kept their expenses pretty flat. So all that extra money just drops straight to the bottom line. It's pure efficiency.
And the engine driving that revenue, the thing we always watch, net interest margin. And now?
The lifeline.
And they finally crossed that big psychological 3% mark. They hit 3.11%, up 10 basis points from last quarter.
And in this environment, crossing 3% is really the difference between just surviving and actually thriving. A lot of banks are getting squeezed, right? Paying high rates for deposits, but stuck with old low-rate loans.
But DCOM broke out of that trap. They're actually making money on the spread again. But I have to ask, was this a clean beat? Did they use any accounting tricks?
No, the street really treated this as clean. There was a little bit of noise in the deposit data, which we should get into, but the core profitability, the organic growth, that was undeniable.
Okay, so let's do the deep dive. How did they pull this off? Because the strategy here feels very different. CEO Stuart Lubow, he calls it an organic strategy.
I like to call it poach, don't purchase.
I like that better. Explain that.
Well, you look around and you see so many banks just trying to grow by buying other banks. It's messy. It takes years. You're dealing with culture clashes.
Purchase accounting nightmares.
Exactly. Dime is doing the opposite. They aren't buying banks. They're hiring the best teams from other banks.
The lift-out model. And they highlighted this on the call. They talked about their chief commercial officer, Tom Giel.
Right. He came over from Sterling, and he did not come alone. He brought a playbook, he brought relationships, and he's attracting talent.
So the narrative is that they're a place for entrepreneurial bankers who are tired of the big bank bureaucracy.
That's it. And they're not just hiring generalists. They're building very specific new verticals. In 2025 alone, they added fund finance, lender finance, mid-corporate.
And sponsor finance. I saw they hired a big name for the New Jersey middle market, too.
They did. And the goal, which Giel said himself, is to have the expertise of, say, a $50 billion bank. But the speed and agility of a $15 billion bank.
And that speed is the real advantage. If you're a business owner and the big bank takes 3 weeks to even look at your loan application.
And DCOM gets you a term sheet in 48 hours, you know who you're going with.
Every single time.
And the proof is in the numbers. Business loans are up over $500 million year over year. And about $400 million of that came directly from these new teams. So this isn't a theory, it's working.
Okay, but you can't lend if you don't have the cash. Let's talk about the other side of the balance sheet, the deposit fortress.
Right.
The headline number was it was massive. $800 million in deposit growth in one quarter. That seems almost too good to be true.
It was a huge number, but this is where you have to, put on your analyst hat for a second. The CFO, Avi Reddy, he was very upfront about this.
Which is good, builds trust.
It does. He flagged that there was about $325 million of what he called noise.
The dreaded asterisk.
It happens. This was mostly seasonal municipal money, tax funds that come in December and go right back out in January. It's transient.
So it's not sticky money. Okay, so if we strip out that $325 million of noise, what are we left with?
We're left with about $400 million of true core organic deposit growth. And to be honest, that is still an incredibly impressive number for one quarter.
It is. But for me, it's not just the volume, it's the quality, the mix. I'm looking at the DDA.
Non-interest-bearing demand deposits.
Free money.
It's free inventory, and it's so hard to find right now. But DCOM has 31% of their total deposits in these zero-interest accounts.
And that's the fuel for the whole machine.
It is, because a third of their funding costs them nothing. Their total cost of deposits at year-end was just 1.68%. Their peers are paying way more. That gap is pure profit.
Which brings us to the NIM expansion engine. You said they hit 3.11%, but the guidance suggests that's not the ceiling. They have this dynamic playing out with their back book.
This is the most bullish part of the whole story. It's like gravity working for them.
Break down the math for us.
Okay, so the back book is just all the loans they made, 3, 4, 5 years ago, back when rates were at rock bottom.
So they're earning, what, 3 or 4% on those loans?
Exactly. But those loans have a lifespan. They mature, they reprice, and when they do, they reset to today's much higher rates.
So what does that calendar look like?
In 2026, this year, they have $1.4 billion of loans repricing. The current rate on that bucket is just 4%.
4%, cheap money.
Super cheap. Now, let's say they reprice those at a 250 basis point spread over the 5-year treasury. That lift, just from that one bucket, adds about 20 basis points to the entire bank's NI by the end of this year.
That is substantial.
And it doesn't stop. In 2027, another $1.7 billion reprices. Those are currently at 4.25%, so that's another 20, maybe 25 basis points. Management isn't just hoping for margin expansion, they have a mathematical runway.
So they're guiding for modest expansion in the first half of the year, but then it really takes off in the second half.
Correct. They're seeing a path to 3.25% and then eventually 3.50% on the NIM. It's an earnings driver that's already baked in. They just have to wait.
Okay, speaking of risk, we have to talk about the elephant in the room for any New York bank.
Commercial real estate, CRE.
Everyone is terrified of office buildings, rent-regulated apartments. It's what keeps investors up at night.
It's the reason the whole sector is trading at a discount. Everyone's afraid of another New York community bank situation.
So where does DCOM stand on this? Or are they hiding a bunch of bad loans?
This is where they're being really smart. They are actively executing a risk-off trade. They're bringing their CRE concentration down. The goal is to get it to the mid-300% range.
And they're doing that by pivoting their business model.
Yes. They're shifting away from those one-off transactional real estate deals and focusing on full relationship business loans, C&I lending. It's safer, it's stickier, and it brings in those great 0% deposits we talked about.
And what's the quality of the current book look like? Their cracks?
Surprisingly few. Their non-performing assets, NPAs, are incredibly low at just 34 basis points. And get this, for multifamily, NPAs are zero.
Zero in this market. That's almost hard to believe.
It speaks to their underwriting, and they've also tackled that one specific New York problem head on, the 100% rent-regulated portfolio.
The stuff that got decimated by the 2019 rent laws.
Right. A few years ago, they had about $500 million of that stuff. They've worked it down to $350 million. And crucially, management said that portfolio is now fully reset.
What does that mean in plain English?
It means they've already taken the pain, they've marked those loans to reality, they aren't carrying them at fantasy 2018 values. The shoe has already dropped.
That's a huge relief for investors. So let's zoom out. You've got this regional bank landscape that's just fractured. Some banks are paralyzed, others are desperate to merge. Where does DCOM fit in?
They're a differentiation story. They're playing offense.
Okay.
And they're using their liquidity as a weapon.
How so?
The CFO, Avi Reddy, he was explicit. He said they are not rushing out to buy a bunch of securities to chase a few extra basis points of yield. They are keeping their powder dry.
So they're preparing for growth, not just chasing yield.
Exactly. They want that cash ready to fund loan growth in the second half of this year when their hiring strategy really starts to hit its stride.
And that goes back to the lift-out strategy. This quarter really proved that it works faster and cleaner than buying a whole bank.
So much cleaner. You don't get the bad loans, the old tech. You just get the talent and their clients. No purchase accounting mess.
So what's the big catalyst for investors to watch?
Q3 2026. Management signaled that's the inflection point. That's when the CRE runoff stops and the overall balance sheet starts growing net positive again. If they hit that, this stock has more room to run.
Okay, that brings us to my favorite part of the show. We've done the numbers, we've done the strategy. Now it's time to get a little creative.
I know where this is going.
But first, of course, the lawyers get their moment. This segment is for entertainment purposes only. This is not, and I repeat not, financial advice.
Do your own diligence. We're just two people talking.
Okay, get me with it. What's the wild trade this quarter?
All right, I call this one the headhunter long-short pair trade.
I love it already. Break it down.
The logic is simple. DCOM is basically acting like a hedge fund of commercial bankers. They are systematically poaching the best talent from the slow, bloated giants in the New York and New Jersey area.
They're draining the talent pool from their competitors.
Exactly. So the trade is this. You go long DCOM, you're betting on the teams they've poached. These people are hungry, they're bringing clients.
And the short side of the trade.
You short the donor banks.
The donors.
Yes. You find the big bureaucratic regionals in the tri-state area that are bleeding talent, the ones with flat revenue, high expenses, and, terrible Glassdoor reviews. Those are the banks losing their rainmakers to DCOM.
So it's a bet on the transfer of human capital. The revenue is physically moving from Bank A to DCOM, but the market hasn't fully priced in the decay at Bank A yet.
Precisely. And if you want the kicker, the real hedge fund part of it, you leverage up the long side. You buy options betting on the NUM hitting 3.50% by 2027.
Which is management's next big target after they clear 3.25%.
It is. If that back book repricing works like the math says it should, 3.50% isn't a fantasy. It's a destination.
So why is this trade outrageous?
Because you're basically ignoring the entire macro picture. You're betting purely on personnel. You're betting that a handful of bankers can move billions of dollars just by changing their business cards.
But why is it plausible?
Because they just proved it works. That's the thing. They generated $400 million in new loans from these teams in 1 year. The model isn't a theory anymore.
I love it. The headhunter pair trade. It's aggressive, a little cynical, and it just might work.
That's the game.
So to wrap this up, DCOM delivered what we're calling the cleanest dirty shirt in the regional bank laundry pile.
Record revenue, real organic growth, and a very clear mathematical path to higher margins.
It's a compelling story. They have the capital, the team, and the math is on their side. And for all of you listening, it's a good reminder to check your own back books. Are your assets repricing higher, or are you stuck in the past?
Always a good question to ask.
That's our time for this deep dive. We will see you on the next print.
Stay sharp.